Hello and welcome again to Debit This, Credit That. I'm Matt Halloran, joined today by Matt Wheeler, the managing partner of Wheeler Accounting. Today, we are discussing why you shouldn't defer income in your retirement gap year. So, Matt, I'd like to start off. Why don't you explain what the retirement gap year is, please?
The retirement gap year, Matt, it's I like to think of it as the period between when you retire, basically, and that varies for everybody, right? It could be your late 50s, early 60s, whenever. When you stop working and your main income source drops off dramatically, that period all the way until age 70, where you have the mandatory distribution rules that kick in for retirement accounts. It's when the latest point at which you can defer your Social Security until, and for some people, maybe they have a pension or something like that that kicks in, and you kind of develop this floor on your income, which it's difficult for us to get below a lot of times from a tax perspective.
Mm-hmm.
So that gap is that period in between that, when you retire and when that age 70 hits. I call that a retirement gap.
There are very, very important tax decisions that can be made and should be made during that time. So let's talk about those, please.
Yeah, I mean, there's a lot of things you can do during that period, and the general concept really is trying to accelerate some of that income that you're going to have after age 70 into that retirement gap period, so you can fill up those bottom tax brackets when you don't have a lot of other income showing, to take full advantage there and spread the income tax hit over a period of several years and move income from the mid-tier brackets, which you're likely going to be in when you're after age 70, into those bottom brackets in the retirement gap years.
Okay. So how do I find out if this is for me, if this is something I should be concerned about? What questions should I ask myself?
If it's me, if I'm approaching retirement, right, a couple of years before retirement, I want to ask myself, what are my sources of liquidity and cash flow in retirement? What am I going to live off of, right? What's the breakdown of my current investments? What percentage do I have in stocks, in bonds, which are going to generate, taxable income, generally interest and dividends? What percentage of my investments do I have in tax-free municipal bonds, where the income is going to be tax-free for federal and state tax purposes generally? Is anything going to be return of capital income that's not taxable to me? Am I going to be getting a pension? When do I think we're going to be drawing on Social Security? Am I considering any larger charitable gifts coming up in the next several years? Is my mortgage close to being paid off? These are a lot of the questions that you want to ask, so we can start to identify, how much income are you going to have during this retirement gap? And then we can start looking at what can we accelerate into that period from what would normally be taxed at the later, post age 70 period.
And so you keep talking about the age 70. So what happens if I retire early? Does this still affect me? If I'm 60 and I retire and I've got 10 years before I can, really hit that max out on Social Security, is this still applicable?
I mean, this is exactly who that affects, right?
Gotcha. Okay.
Yeah. We want to find someone who has a longer retirement gap period, because there's more we can do to smooth that income out over a period of years. I kind of think of it like your earnings is kind of like the course of your life. You're going on a hike through the mountains, right? And your elevation gain and loss is kind of like your income level over the years. You start out in the valley floor, you're making nothing in your 20s, right? Walk into the foothills, start getting into the mountains, you're going up, it goes down every once in a while, get laid off, whatever, get a new job, get lucky, climb up a cliff or something, and then you reach peak earnings kind of in your 50s, right? Then you start to head back down the mountain a little bit. And what some people do when they get to retirement is it's like they're just base jumping off the mountain, straight down to the valley floor, right?
Sure.
And just a complete drop off. And that's pretty jarring to the body and, mentally and physically probably. And so what you want to do is kind of take the, smoother route down, right? And smooth out your income. So when you get to age 70, you're just on a nice little walk through a higher elevation valley, I guess you would call it. But get the idea.
I do. That's a wonderful analogy, especially the base jumping. I think that's exactly what a lot of people do. So Why is this important, though? I mean, not just from a tax perspective, but obviously when you're base jumping off of a mountain, it's terrifying. And what I'm hearing you talk about is the fact that you can smooth this out so that this big gap isn't as scary. But why else is this so important?
It's just about having a long-term tax strategy, I think. And if you don't do any planning, a lot of people, if you had no income during the retirement gap years, no real income to speak of, right? Your W-2 earnings are all gone. You have some money saved up in some taxable and savings accounts. You're going to go travel the world and do some cruises or whatever. And you're not going to draw Social Security for a few years. Your pension doesn't kick in until a few years. I got a lot of clients where they come to me at tax time and we do last year's return, and the income is zeroes out for the year, or maybe even sometimes it goes negative if you got your usual deductions like your mortgage and your property taxes and that kind of stuff. And that's a wasted opportunity, because we could have accelerated some income into that year and paid no tax possibly, or very little tax, by again maximizing that bottom tier tax bracket if we had planned more effectively. So that's really, why it's important, is you want to take that income that's going to be taxed in the mid-tier tax rates, or maybe even the top tax rates later, when all your distributions from your retirement accounts and everything kick in, tax at the lower rates right now. Maybe even, do some specific strategies that can, get that to be tax-free income later by recognizing the income now.
So you have 6 steps, right? 6 specific strategies that we can use in this gap year. And you've already touched on some of them, but let's break them down more individually. So let's start with number 1, and this is the big one, right? So what are the solutions that our listeners can actually implement with their CPA if they're not working with you specifically in these retirement gap years?
My big go-to during this period is we want to look at doing a Roth conversion, right? So that's when you take a pre-tax retirement account like a 401k or an IRA. All the money in that account is pre-tax money. So when you're going to pull it out of the account, you're going to pay ordinary income tax, or have it be taxed at ordinary rates on that income. And what we can do with a Roth conversion is we can convert a portion of the account into a Roth IRA. Now, a Roth IRA, when you take distributions in the future, all the distributions out of that Roth IRA are tax-free. The Roth IRA is also not subject to that age 70 and a half minimum distributions. So we look at trying to do a Roth conversion during the low income years. If you're a very low income or even a negative income kind of situation, we can usually convert a little chunk of the IRA each year. Maybe it's 20,000, maybe it's 40 or 50,000 into a Roth. You recognize income when you do the conversion, but if you're in the bottom bracket, if you have negative income, we try and hit the break even point to where you don't pay any tax, or maybe you pay a little bit of tax in that conversion. So now you've accelerated income from later years into the current year, but you don't pay any actual tax because you're in the bottom tax bracket, or your taxable income is negative. And now all the future withdrawals out of the account are going to be tax free. So Roth conversion is one of the main strategies I like to go to during this period and see if it's something that we can use as a tool to take advantage of that retirement gap.
And when you actually retire, and I'm air quoting there, that's another main consideration, right? So how do you help people consider when they should do that?
Yeah, usually we're looking at kind of, the year we're going to retire, when to retire. And usually people usually have some flexibility there, right? And there's a lot of factors they want to consider. How much accrued vacation do you have? Do you have a bonus coming up that always comes at a certain period of the year? Obviously you want to make sure you take advantage of that in your final year, and unexercised stock options as well, right? So for a lot of people, we generally sometimes will think about retiring later in the year, within the last quarter of the year. And that does a couple of things for us. One, if you have unexercised stock options, you generally have 90 days after you leave the company to exercise those options. So if you time it right, and that 90 days can fall into 2 separate tax years, you have a lot of flexibility on when to recognize that income. You can straddle it over 2 years. That can be huge. You can defer some of the income from the options to the following tax year where you're not going to have any other income really, and hit a lower tax rate than if you had to do it all in the year of retirement, especially if they were going to give you some golden watch bonus at the end, right? Or pay all your accrued vacation and that kind of stuff. You're going to be in a high bracket possibly that last year. So retiring in the last quarter, you can shift, or you can decide, which tax year you want to recognize that option income in. And, similarly, you can also retire kind of near the end of the year. So your accrued vacation payout maybe happens in January instead of December. So again, getting into the next tax year, some of those kind of things. So end of the year is pretty popular time, or very beginning of the year. So you're not having a lot of income in the subsequent tax year, basically.
Is this, I'm sorry, I'm going to digress here very quickly. So is this something that you normally do with your clients at Wheeler? I mean, so do you sit down with people, and how do you identify people and begin this conversation? I'm sorry, we're again, I'm digressing here. It's just you're saying so many different things that seem so out of the ordinary for a client of an accounting firm to have that conversation with somebody like